Hello, this is Moss 3311 and this is our finance group project. I'm Mo and I'll be covering the intro and the conclusion. So we are a group of consultants who are targeting risk-seeking individuals. The reason why we chose to target those individuals is due to the fact that risky investments tend to look great by offering great return, and many investors would be deceived by seeing enormous potential returns and deciding to invest in risky investments. By targeting risk-seeking individuals, we are dealing with investors who know that they might lose money and want to risk it all to try to increase their net worth. By analyzing a portfolio of risky investments, we try to give advice to those risk-seeking individuals in order to help them decide what to invest in from those high-risk stocks that will generate a high return while trying to limit the potential loss should things not go right.
All right, my name is Jeff. I'll be covering the analysis of the stock. All of our data is sourced from Yahoo Finance. The timestamp ranges from January 1st, 2013 to December 31st, 2015. The data is formulated from 3 years of financials over 4 separate companies. TD's performance is quite stable. When we look at TD's stock quotes, it is evident that the bank has consistent growth over the past 3 years as the value of their shares have risen. The variance is at 0.951, displaying a non-risky kind of investment opportunity. The returns are average in comparison to the market, which suggests TD is a good investment for investors looking for stable, long-term opportunities. Next, we have 3M. 3M's performance is more volatile compared to the market. When looking at 3M stock quotes, there's been a consistent growth with upwards trending share value. The standard deviation of 0.994 suggests that there's more fluctuation in share value compared to the market. The returns are very stable, making for a safe investment. We suggest that 3M is a great stock to have with its increasing share value and fair returns. Next, we have Rogers. Rogers' performance has been on the decline. Over the past 3 years, the value of each share has decreased. The trend has been going downwards, and there is a high variance of 1.56. This means that there's more risk to be taken on, and we see that Rogers is our second most risky stock, and we do not suggest investing here. Suncor's performance is what we have next. Their performance has been quite volatile. The variance of the portfolio is quite high at 2.88, and we witnessed an overall decrease in value of the stock over 3 years. Suncor is our most risky stock, but the return has also happened to be the greatest. The standard deviation also seems to be trending quite high at 1.7, reflecting its high risk profile. Suncor is not a stock you want to have in your portfolio if you're a non-risky investor. That is all for the analysis of the stock.
I am Alicia, and I will be speaking about the analysis of the portfolio. Our portfolio consisted of two risky assets, 3M and TD, as well as the S&P 500 index. Now, if we take a look at the correlation between each of the two risky assets and the S&P 500, we can see that the correlation is actually quite high, and this is to be expected as both of these companies are large, well-established companies in their industries, and therefore their returns will move in tandem with the market. The correlation between 3M and TD is fairly low at about 0.45. Ideally, you would like a correlation that's negative, but since we're dealing with investors who can take on a bit of risk for a higher return, we are able to deal with this 0.45 correlation. Next, we'll look at the target returns and the risk of this portfolio. So as you can see, as the returns increase, the risk actually decreases when we're looking at our target returns between 0.01 to 0.04. This created an interesting efficient frontier, which is sort of a mirror image of what you would normally see, whereas returns increase, the risk increases as well. However, once we get to our target return of 0.06, the risk seems to catch up with the return. Lastly, I'll show you what Solver thought was optimal, which is to invest mostly in 3M, secondly in the S&P 500 index, and lastly in TD to get us a risk of about 1.21 and a return of about 0.10%. And I'll move on to Naji.
Hi everybody, my name is Naji and I'll be talking about analysis of the portfolio with a risk-free asset. And bear with me 1 second. Okay, we look at the calculation of the coefficient frontier, which has to do with the CAPM. I'll show it to you right here. It's the expected return with the risk-free asset return plus the beta times the market return minus the risk-free return. This right here represents the risk premium that the investor expects for a risky asset. And you can see based on efficient frontier, we have a smooth line connecting through most of the dots. Next thing, we're going to talk about the results. These are a target range. You can see the optimal results that Solver concluded that we should invest 33% in T-bills, 33% in TD, and 33% in 3M. This gives us a risk of 0.571 and a return of 0.302. And I'll pass on to Mo for the conclusion.
The optimal solution that the Solver came up with was to invest 1/3 of the investment in each of the T-bill, TD, and 3M. We advise our investors seeking a high return while attempting to minimize risk to use this guide. Both TD and 3M's betas are close to 1, which means that they move with the market. This means that they are risky assets, which is to be expected for a higher expected return. TD and 3M provide the highest return of the 4 risky investments we analyzed. Investing 1/3 in each of T-bills, TD, and 3M provide the investor with a return of 0.30% with a beta of 0.57. Additionally, we would advise an investor to purchase an ETF on the S&P 500. This index provides a high return of 0.05% while exposing the investor to a low risk of 0.64. And that's it. Thank you.